Good morning, Namaskar. Today I am going to discuss a topic on stocks, and the name given to topic I have given is stock investing, science or luck. How much is the science? How much is the luck? People like you and me who are retail investors, we invest in stock market to get some alpha returns. We have a small businesses, we have a service, but everybody needs a extra income to support your lifestyle or to get something extra in the life. It is said that money cannot buy happiness, but it can vastly improve the quality of your misery. So anything extra income is welcome. And you hear stories in the stock, somebody bought XYZ stock at 10 rupees, now it has become 300 rupees, he got so many bonuses, he got so many dividends. So everybody likes to dabble in stock, but interaction with many investors in the past, I realized that nobody is content, nobody is happy. On one part they are happy about certain stocks, but in other stocks their capital has completely wiped out. So the question comes, stock investing, is it science or luck? I have seen my friend liquidating his entire portfolio just after Modi came to the government. BJP government was elected with the majority. He sold all his stock. He couldn't stomach the volatility in it. And later on he is repeating now, oh my God, my portfolio would have got doubled. So most of the investors feel it is sheer luck. Market is driven by operators. It is not meant for retail investors. I am going to stay away from the market. I will invest in fixed deposit and I will be happy about it. It is not my cup of tea. So stock investing, is it really a luck? Or is there any method? Is there any science? Because in India, thousands of crores, abroad billions of dollars get invested by hedge funds, fund managers and private equity capital. So there has to be some science. Otherwise they cannot invest just like that and later on say, oh, it was luck, I lost money there. So you and me as a retail investor, what can we do? Where to look for? What science we can follow? What methods we can follow? So my point is, as a retail investor, due to advent of internet, many things are possible. You can check shareholding pattern, you can check minute to minute price, you can day trade on the mobile, and you can check shareholding patterns, you can check bulk deals. So because of internet, it is no more a riddle or enigma. Information is available at the tip of your fingertip. It is said stocks are, it is a riddle unwrapped in mystery, inside an enigma. Is it really so? Or is there any method? Is there any scientific base? My point is that as a retail investor, a recourse is available and you can check many things on the internet. If a friend tells you that XYZ stock is good, then what you yourself as an investor who is putting your hard-earned money can check about that ABC or XYZ stock. After checking this due diligence, then leave it to your luck part. If something goes wrong in the company, it's a different matter. First remember this, equity is a risk instrument and that asset is very, very volatile. Equity's nature itself is volatile. Everybody on the channel says markets these days are volatile. Not these days, they are always volatile. On the upsides, they keep going, but when the correction comes, it can come 10%, 20% as a whole. Something happens in Iraq, something happens in Libya, and the next day market collapses here. So, world India is now integrated into the world in financial markets. Something happens in China, rate cuts, IPO, it affects our market. So, let us go one by one. As a retail investor, what you can check. So, let us check with bonus and its after effects and splits. Bonus is a strong indication from a management that future is going to be bullish, and the higher equity because of bonus can be serviced. Everybody has seen Infosys, Wipro, Cipla, and there are so many stocks after bonus. Not only one, there are 2 or 3 or 4. They have flourished. They never stopped growing. They kept growing up in a big way. Infosys, when it started, its market cap was hardly few crores. Today is one of the probably top 10 or 15 stocks. So, bonus is a strong indication from management future is bullish. Even the split, when the stock becomes expensive, I have seen many stocks, I have studied many stocks, about 70 or 80% of the stocks after bonus and split have been outperformer. A small cap like Atul Auto or Ajanta Pharma, whenever they have shares have been split or bonus has been given, there is a effect on the counter after stock becomes X bonus. Retail investors sell their 100 shares and keep 100 coming out of the bonus. Initially there is a correction, but all these companies have shown how much their profits have grown after stocks gave bonus and they split the shares. Now in stock market, 8 or 9 companies you can say that yes, bonus and split does really help. But there are companies like Sharon Bio, or there are 1 or 2 more examples. After bonus and split, they have not lived up to the expectations and their stocks have collapsed because of some other reasons. Now let me give a disclosure here. When I start taking names of the companies, I could be having vested interest in them, and it is not a recommendation that it is buy, sell or hold. Or when I take names of the companies or management, it is based on a factual position, what happened in the market, and it is not my intention to defame a particular management or a company. So please keep that in mind. So bonus basically is an indication that future is bullish, you should keep. I'll give you another example. A company called a small cap during those days was Poly Medicure. It had products in medical equipments and ancillary products in medical field. It was probably just 1 or 2 listed players in the market. And when you look at India's demography, this company had a very strong chance to grow. They gave 1 or 2 bonus, they split the shares, and it has been multi-bagger of 10 or 15 kind in last 6 or 7 years. But bonus, whenever a company gives a bonus, and if you buy, you need to give time to a company. There are instances in the company after bonus, nothing happened for 1 or 2 years, but after 1 or 2 years, stock has really become caught the fancy of the market. It brought the attention of the market players, and it has become multi-bagger after 3-4 years. So bonus not necessarily means immediately after bonus the stock will be outperformer. You need to be patient. So that is about bonus and splits. Now let us go to what else we can check. Nowadays annual reports of the last year, financial year, and previous to that are readily available on BSE website and on that particular company's website. Annual reports, in the annual report, chairman's opening statement, investor presentation after the annual report or every quarter, they give lot of insights to the investors. What is there in the future? What company intends to do with the capital expenditure program? What their products are doing well or not in the market? Where is the pressure? Margin pressure is because of what? Everything is detailed in the investor presentation. And let us say in the second quarter, if the investor presentation comes, you don't need to wait till the financial report at the end of the year. And there are most companies like, of course, mid caps do give investor presentation, but companies like Atul Limited or SR or Godrej or Aegis Logistics or Gujarat Pipavav, all these companies, you go to their investor presentation and you will be quite impressed. And most of the time their presentation is accurate on the future path of the company. So if somebody says buy Aegis Logistics, then go to Aegis Logistics page. It's a liquid storage logistic company, chemical handling in gas. There are 3 or 4 verticals. Go to the last quarterly results and you will find investor presentation. That company is going to do expansion at Pipavav port, or say company has got 5 acres of land for expansion, or say a nod has come from environment ministry from the center, and the expansion can be done at Pipavav port. So all this news is readily available in investor presentation. So if somebody says buy XYZ stock, go to the stock page, check when investor presentation is there, and at least you know where the growth will come from, what lies in the future. Now next we'll go to the shareholding pattern. Shareholding pattern is the key in most of the stocks. I love to check shareholding pattern, especially of small caps and mid caps. Shareholding pattern tells you which are the mutual fund schemes, if there are any, have invested, if there are any private equity partner, how many financial institutions have invested and what is their stake. There could be a company, only 5 financial institutions hold 15%, or there could be a large cap where 50 or 100 or 250 financial institutions have stake, but only maybe 10 or 12% because the company is very large. And when you check shareholding pattern, you also come to know how many retail investors hold in that particular company. What is the float available? There are companies like Vaibhav Global or Page Industries some time back, or let's say APL Apollo Tubes. Most of the stock float is captured or held by promoters. 60 to 75%, 75% is now maximum available for promoters, and financial institutions and mutual fund schemes have cornered most of the float, and retail investors, just 5,000 or 7,000 or maybe 15,000 of them hold just 1 or 2%. That shows immense potential in that particular company. And shareholding patterns are readily available on many websites, and not only that, on bseindia.com, if you can go to archives section, you can see last year or 5 years back, retail investors were holding 15%, now they are holding only 5%, because at every rise they sold everything and the stock float was lapped up by mutual funds and HNI and financial institutions. And there are companies like, say, Page Industries or Solar Industries. Many of the companies, financial institutions presence of particular financial institutional presence is very important. Like, there are hundreds and thousands of institutions and mutual fund schemes, but there are some good names known in the market whose performance in India has been exemplary, has been excellent, outstanding. I'll tell you one or two names, like HDFC Mid Cap Opportunities Fund, IDFC Premier Equity Scheme, or a financial institution called Amansa or Nalanda Fund, or a Small Cap World Fund, or Temasek, which is a Singapore government's investment arm. All these funds, their portfolios are available online. You can check, and you can check those stocks have been outstanding performers. They have been outperformers. So my question is, if the retail investors are holding a minuscule portion in that particular company, why not you also get invested? Because the very fact that the rest of the float stock is been taken by big names, it makes sense. You buy small quantity and just leave it like that. You stand a good chance to be successful in that particular stock. So that is shareholding pattern. Excuse me. Now let us go to capital expenditure program called CAPEX. Companies like SRF, Aegis Logistics, Gujarat Pipavav, Cummins, many companies do capital expenditure program on year-to-year basis, and they are very successful by converting that capital expenditure into higher sales and higher dividend. You will find capital expenditure program in annual reports, and it makes a good sense to go through investor presentation. What is the operational cash flow versus the capital expenditure in those companies? Now next we will see volume breakout theory. In technical charts, there are various parameters by which you can check how stock is going to perform, and every day you will see a day trader or short term investor, and a lot of experts on TV channels will tell you on various technical parameters how a particular stock or nifty or index is going to perform. But as a retail investor, it is not possible for everybody to check technical theories, study, and you need a good software, and even if you know the technical parameters, it is very difficult to find the conclusion out of it decisively and buy a stock, because they will always say stop loss XYZ. So if market corrects by 700 points and if you are not kept stop loss, so it is not possible to go into that. As a layman investors, over a period I found most of today's outperformers or multi-baggers, if you check their 10-year chart, at one point they showed a very large volume, and I can tell you about 30 or 40 stocks like that. This particular volume theory, you need to check that there is no bulk deal which has taken place. Like Morgan Stanley has sold to Goldman Sachs has sold to some other financial institution. No, there should not be any bulk deal. So if you check SRF or Page Industries or Gujarat Pipavav or Aegis Logistics, you check any stock today, even 1 year chart, a stock which was like say 150 and today it is at 600, at 200, at 300, at 350, there have been regular spurts of volume in a very big way. It's an accumulation phase. Somebody smart investor is trying to accumulate that stock. Stock will correct. Stock might have gone from 100 to 300. It could have come down to 200, but now today is at 600. So volume theory in very good stock is very beneficial, and I myself have benefited in many stock because of the volume theory, or I was able to predict that XYZ stock is going to do well in 6 months or 9 months time. So as a layman retail investor, it's good to know whether any volume breakout has taken place. In Economic Times, there is a statistics page, and it will show you which are the stocks yesterday have shown extra volumes. Now let us go to high date traps. Companies want to grow big. They want to be top class company in that particular field. To grow, either you need to come out with IPO or you need to borrow large sums of money. If you are successful, the stock becomes outperformer, and if the debt burden cannot be serviced, the stocks collapses. This is the beauty of stocks. This is a risk instrument, and this risk can come in various forms. So there are 3-4 names. First, I'll take name of JP Infra. JP Infra holds hectares of land in Noida region. They are also owners of Yamuna Expressway, but Yamuna Expressway, a lot of expenditure was incurred for building that long expressway. They had to borrow large sums of money. Most of their promoters have placed their shares to a very large extent, and nothing is happening in the company. There is a realty slowdown. So the high cost of the debt got reflected in the stock, and after IPO, JP Infra has only slided down and down. Take another high flyer, Suzlon, wind turbine maker. It bought a company in Europe. It became one of the top 5 players in the world. But there were various issues after company bought that European company. That particular company was bought by borrowing large sums of money, and the interest portion could not be serviced. At a time, Suzlon was quoting at 100, it was making losses. Even at 50, it was a good sell. But investor latched on to the stock thinking that it is one of the top player in the world. So today or tomorrow they will get more orders, company will become profitable, it will become multi-bagger. But nothing of that sort of happened. So company which has borrowed large sums of money and promoters have pledged shares, you need to check. In shareholding pattern on BSE India, if you check, the top portion will tell you promoters hold how much stake in the company, and there will be a right hand side column which will tell you out of that 67% or 75% which promoters hold, what percentage of the stock has been pledged. Now this pledge is another issue. By pledging share, whether promoters are using that money for the company's use or for their personal use, there are so many things involved. But in last 3-4 years, pledged shares have caused a havoc in the market. So if you are buying into a stock, it is very big risk, and you need to check in shareholding pattern whether pledge, how much is the pledge, whether it has come down on quarter to quarter basis or year to year basis. So debt, higher debt and pledge shares, that also you can check very easily. Now let's go to another topic, when to get out of the stock. You have a stock, it has been multi-bagger for 4 or 5 years. Excuse me. It has been multi-bagger for 4 or 5 years. But now a situation has come where things are not rosy. For example, Punj Lloyd was a very good infra company, and it was considered as mini Larsen and Toubro. Rakesh Jhunjhunwala, big bull, had invested a very big sum. He was holding big stake during that time. Company had a project, one of its subsidiary in Europe, and there was a delay in project, and there was a court case, and company had to pay fine of almost 200 crores. They had to write it off. After that, stock has collapsed and it has not come back. It was a clear sign company's 200 crores down the drain at one stroke. Second example is Suzlon, a very high debt. Company's promoter was going here and there, going round and round, trying to cut down his debt, meeting various financial institutions. How is going to devote time to the company's working itself? It was a clear sign, it was a clear sell. Take case of Jindal. After the coal scam came in the open, coal mines, one of the Jindal company was involved in that. Things went from bad to worse. When you have a doubt like this, if you are holding a Jindal share, at least sell some part. No doubt about it. No need to take a second thought. So when you see a company is in trouble and there is a reason behind it and there is no clarity on it, just get out of it. Why wait? After this, we will go to a demerger theory. There are companies, you will not find too many companies in this particular section, but the latest example or recent example is Sun Advanced Pharma or Marico Kaya from Marico, or there is a small cap called Kesar Terminal, which was carved out of Kesar Enterprises. So all these companies, management has certain ambition. It's a subsidiary of a company, but the business of parent is different and the business of subsidiary is different. So they have demerged the company into a separate entity, and most of the times investors have been benefited. Just see the Marico Kaya after the demerger. From 200 and 300 of listing, it has gone to as high as 2,300 because it had a tremendous potential. So Marico as a FMCG company managed to carve out of it Marico Kaya, get it separately listed, so everybody got benefited. Same thing with Kesar Terminal, it's a very small cap. The parent company Kesar Enterprises of Kilachans is making losses, but their subsidiary Kesar Terminal had a business of liquid logistic storage, just like Aegis Logistics, and they carved out this company and they started paying dividend right from first year, and from 20 and 30 rupees stock has grown to 50 rupees because operating margins are very high in liquid storage. Or a Polaris demerged and it came out with Intellect Design Area, which has a banking products. Even that holds tremendous potential. So that is demerger. So whenever a company is demerging is one of its subsidiaries, you can go through the management statements, what they want to say, what is the logic behind it. There will be a special extraordinary general body meeting. You will get a leaflet or brochure saying what are the benefits of it. So all these things you can keep a track in the market and buy those shares. Next is dividend yield traps. Whenever market goes down, the print media and TV channel, they start telling you buy XYZ, buy ABC, 7% yield, 5% yield. But after 3-4 years, those stocks have disappeared. Forget about dividend yield. Net profits have fallen. So many things have taken place. And the expensive stocks like Jubilant Foodwork or MRF or Gillette or Nestle, they have grown strength to strength. They are in the price earning ratio club of 100 or 200. So dividend yield stocks, they are a trap, and you need to check on an individual basis whether it is really worth to buy the stock. I will just give you one example. Noida toll bridge. A research house had given recommendation saying that it fits into a Warren Buffett theory in its philosophy. Good dividend yield stock. Past 3-4 years, stock is in a tight range. It has not even moved beyond 40. Or say graphite, it's an electrode company. Electrodes are used in electric arc furnaces for steel making. It used to offer 5 or 6% dividend yield, but nothing has happened. 80, 100, 110, same thing. Other companies have grown 4 or 5 times or 10 times. So some of these stocks, dividend yield stocks, you need to check, and please don't fall trap into it. Next we will check go against the tide. Like for example, Piramal sold their formulation business to Abbott. They got about 15,000 crores. Market was expecting a very good dividend from the company, but company disappointed market and gave only 6 rupees as a special dividend. So they hammered the counter and it started showing 52-week low. One research house even closed the call on Piramal, saying that they have 15,000 crores, but they are diversifying into various businesses and there is no clarity. So we don't recommend you to invest in Piramal. But I was holding Piramal for a long time and I trusted instincts of Ajay Piramal. He is a magician. He has bought 15-20 companies and turned them into profitable companies. When he sold formulation business in India, the interest rate cycle had peaked. There was no money in the market for the businesses to invest. And here there was a company with 15,000 crores of cash. They needed to invest that judiciously in various businesses, various verticals. And stock from the lows of 360s now has crossed 1,000 rupees. So it is a special situation call. A 15,000 crore company, debt free, they just need to invest 300 crores here, 500 crores here, 1,000 crore in realty. Vodafone stake bought at XYZ price, sold at 30% profit margin. They gave 50 rupees dividend as special dividend after they made profit in Vodafone. So there are special situations and you find that particular stock it's a contra buy. You need to go against the market. You need to have conviction. It's a contra buy, and sometimes it so happens that market was right and you were wrong. But I was very much confident on Ajay Piramal that time and I invested in Piramal and it has benefited me tremendously. Now let us go to corporate governance issue. There are stocks where corporate governance has played a major role and lot of investors have burned their fingers. Please check the signs or corporate announcements. There is one jewelry company. The jewelry company invested about 200 or 400 crores of its profit into solar division. No information was given. Where exactly is the solar park? What is the income out of it? And it was a clear governance issue. The same company declared 30% dividend and in annual meeting the promoters themselves objected for not recommending any dividend. So there are many signs whereby you will see, you can smell a corporate governance issue. And there are some IT software stocks, people have lost completely their capital. They were all dividend paying companies. Financial institutions were holding that stock, but shares played a havoc. And corporate governance, there is a South company, it's into print media, but because of the flamboyant style of promoters, they pledge lot of shares, and stock has become a penny stock. Special situation stocks. Special situation stock, I'll give you best example, is like that of Maruti. Maruti is a premier automobile company. It commanded always a good market share, and in spite of many other foreign names, the company's products still carried a waiting list. Whatever the price of the petrol, Maruti Suzuki always grew. But situation came, there was a labor strike, there was a serious kind of labor strike, and they had to shut down one plant, and there was some issue of temporary workers demanding extra money or whatever. And after few days, Maruti Suzuki's plant reopened. For sure, for final, everything was settled. Stock had already corrected because one plant was not giving output from that closed factory. There was a brokerage upgrade on Maruti, and it was a clear sign that it was a good buy, of course in hindsight. But if you see such kind of situation, and if you feel there is a market leader, then just go for it. So these are the signs and these are the things to check as a retail investors. But at the same time, equity is a risk. Things may not go as you plan. People still lose money. I have lost money, and many of my experiences have come after losing money. That's why I was able to narrate my experience today. Thank you for watching me. This is first part. Maybe there will be a second part. Happy investing. All the best to you. Thank you.